Welcome to this manufacturing industry debrief session. Hopefully you've just come off the back of our budget webinar with Sayed, Hugh and Emily, and you found that very informative. My name's Michael Clemson. I'm Grant Thornton's National Head of Manufacturing. I'm joined here by Nick Love. Good afternoon, Nick. How you going?
Well, thanks, Michael.
Nick's a director in our private advisory division. He's also a member of the manufacturing industry team. So he can help unpack some of those tax questions no doubt the audience may throw to us. Look, it's only a short session, really. Nick and I will just sort of bounce some ideas around what we've seen out of the budget so far. It's only early days, what it does mean for manufacturing, what it may mean. Look, we've got a polling question there just to get a general feel for how the audience feels about the budget, whether they're feeling from an economic outlook, whether that's positive, neutral or negative. I encourage you to sort of enter those numbers, and I'll let you know just sort of towards the end of the session the results of that. Otherwise, there's sort of a function in there just to type in the chat room, just to type questions you've got. We may group them. We may not get to them all. We'll see how we go, but we'll do our best. Look, I might kick it off, Nick, with a question to you. I mean, the budget. I mean, is it a big spending budget? Is it moderate, or have they sort of scaled back on what people might have thought they would be doing, with this budget overall, not necessarily for manufacturing?
I know it's certainly a big spending budget, Michael. We've seen the forecasts of what the deficits are going to look like. Not necessarily a whole heap of information on what government revenue looks like for the next few years, but the deficits are pretty big. I think it was 160 billion or thereabouts in the first year, and then reducing over the next couple of years. But that's absolutely on the back of a lot of spending over the next sort of 4 or 5 years.
Yeah. Well, I think you're right. It's 161 billion into 100 billion deficit into 100 billion deficit. You can't help but reflect. Maybe 4 years ago, any deficit was a big problem, and as we almost certainly head towards a $1 trillion debt balance, I think we've just had a complete rethink by government as to what a deficit means, for this country. And I think there's a clear mindset that we're going to spend our way out of this, COVID-induced recession, and the numbers, would certainly suggest that's exactly what's happening. So 160 billion, what does it mean for manufacturing is probably the question of this audience. Have we seen anything big and exciting in this budget for manufacturers from what you're seeing there, Nick?
Look, from my perspective, it's a pretty different budget to the last one. That might sound a little bit obvious, but 6-7 months ago when we had the last budget, we had some really big tax reforms, if you like, and the two big ones that we had there was the temporary full expensing and the loss carryback offset. So I'm pleased to see them extended. That's really good news. That's really good news for businesses. It just gives us an extra sort of 12 months or so to manage our way through them and use those particular tax breaks, to keep our businesses running, keep the working capital in the business. The rest of what I'm seeing, it's a bit of a departure from the last budget where we did have these, it wasn't, the temporary full expensing and the loss carryback as the example was sort of industry agnostic and accessible to most businesses around the place. I think on the back of what Emily was saying in the last session, that the government's really handing the baton over to businesses now. The way I look at it is the government's trying to encourage certain behaviours, and most of those behaviours are around innovation. So that's a bit of a difference in this budget.
Yeah, and I see a question, from the audience early on. Thank you, around just our ability to compete internationally. And I guess that sort of fits in, Nick, with what you're saying with the government's push for innovation. The patent box is something that's new. It's been around in the UK for some time, but what do we know about that?
Details are pretty light on the patent box so far. We know that it's been rolled out specifically for the medical and biotech industries, and with the government to then sort of consult on the clean energy industries as well. But essentially the patent box starting from 1 July 2022, and it's saying that any income from Australian patents is going to be taxed to the company at 17%, which is nearly half the sort of corporate tax rate, if you're at that 30% tax rate. So that's a significant reduction. Some of the commentary that I've read, so there's not a whole lot of detail on how, how do we calculate what portion of our income or profits or taxable income or whatever is taxed at 17%. Part of what I've read seems that they're potentially making a link between, what percentage of research and development have you done in Australia or undertaken in Australia, and linking that to the percentage of your income that will be taxed concessionally. But at the moment, look, its details are pretty light, due to start in a bit over 12 months. So I'm sure we'll see a lot more detail coming out on that.
Yeah, and look, just speaking briefly, with our national head of life sciences, Michael Cunningham, he certainly welcomed the news, for manufacturers in that space. They've certainly been wanting. They've been, campaigning for this kind of reform. So it certainly seems welcome news for them.
Welcome news, but pretty narrow in terms of industry. I sort of would have thought that from a starting point, they would have picked, the 6 sort of national priority areas that the MMI was targeted at. So they've taken the medical products out of that list, but then there's 5 others that have been missed, not to mention the rest of the manufacturing industries that we have around the country.
Yeah, I would certainly welcome it to be brought, no doubt at all. I mean, there's talk potentially, renewables, clean tech, but, that there's no confirmation that's in yet. So certainly doubt around that. The R&D incentives, I've heard a number of 2 billion. That will be good for manufacturing. Is there any insights or comments you'd like to sort of share on that, Nick?
Yeah, look, not a whole lot of R&D tax incentive as we know it, the one that sort of we get the refundable tax credit with our tax return. Not a lot of that mentioned in the budget. Where R&D was mentioned is that some of the I guess business behaviours that the government's trying to encourage is encouraging research and development. So that's things like the patent box. So that's all around, do the research and development in Australia, commercialise it in Australia, and keep it in Australia. The other one is that the government's going to allow businesses to self-assess the life of some of their intangible assets, which essentially just means it gives businesses the opportunity to depreciate an intangible asset, which in this case could be some form of intellectual property. Typically, that might be done over 5 or 20 years, and self-assess the life of it and say it's only going to last 1 or 2 or 3 years, and depreciate it over a much shorter period of time. These are the sorts of reforms that the government's brought in that's going to enable, in this case, manufacturers to invest in research and development and see some sort of return on that investment.
Now, can we talk a little bit more, Nick, about the capital asset write-off? Just the rules around that. Obviously, that's been extended out to 2023, I believe. Just for manufacturers, I mean, how much can they claim? And just remind the audience what it means.
Yeah, sure. Look, I think it's a pretty good set of rules, really. I'm glad to see it extended. So the temporary full expensing applies to businesses that have an aggregated turnover of less than 5 billion with a B. So, that's going to capture probably almost every business in the country except for a few. Just gives you the ability to write off brand new assets without any cost limit on that asset in the year that you acquire it. Okay, if your turnover is less than 50 million, then that also applies to second-hand assets, which is great. And what the extension to these rules means that, essentially, if you make that investment between October 2020, when the last budget was, and 30 June 2023, which is the extended date, that you're going to be able to write off those assets in full. So look, as I said, it's a good set of rules. We've got some, really high sort of turnover thresholds for your eligibility, no cap on the cost of assets that can be acquired. Essentially, what it means is that a manufacturer could go and make a pretty substantial investment in plant and equipment, and deduct that in the first year. And I think, Michael, when we were chatting before, you've sort of seen that in practice in some of your clients.
Oh, it certainly. I mean, when you start with it, you hear, oh, well, it's a timing difference, right? So you would otherwise get a tax deduction for, you're going to get the same amount. It's not an additional tax deduction, but the real power behind it is getting it all up front, right? Getting it all in year one. Now, if companies are looking at cash flow management, and they're looking at trade-offs, where to spend money, and you look at CapEx that you would like to do, and let's say, it's to throw a number out there, it's 200,000 in CapEx you're looking to do. If you get an immediate 30% tax deduction in 1 year, that's $60,000. If you're otherwise paying tax, that's actually $60,000 of cash in your pocket as a company. Now you might go and acquire that on finance. Debt's pretty cheap at the moment. And so essentially you can be getting use of that asset for potentially the first 2 or 3 years for free from a cash flow perspective. Further down the track, it will catch up with you and you have to pay it. But that incentive in the short term of having that asset can become very appealing. Now, if you're a manufacturer buying that equipment, that changes your cash flow dynamic immediately. It can actually, as I say, put your cash flow positive year one, maybe even in year two, and starts neutral year three after that. In terms of if you're making a product that others are buying, your product's becoming much more in demand because of this change. So it certainly changes, behaviours. Even though it's a timing issue, it's a real issue and it's real cash flow, and that's how clients see it. So so look,
just
a question
sorry,
come through. Yeah, go ahead.
Sorry, Michael. Just while we're on tax, just the other sort of headline tax measure from last year's budget that was extended in this year's budget is the loss carryback. So just in a nutshell, if you made a loss in 30 June 20, 21, 22, 23 and paid tax in essentially any year prior to the loss year, except starting from 2019, you can carry your loss in the current year back against the profit in the year before that. There's a couple of caps on it, subject to your franking account and that sort of stuff. That's also limited to businesses with an aggregated turnover under $5 billion. The really interesting thing about this is that, this was designed to work hand in hand with the temporary full expensing. What I mean by that is, say in 1 year, we've got a company that's profitable and taxable, and the following year they've got a really large investment in plant and equipment. They can write that equipment off, which might put them into a loss position. They can write all that equipment off in the year that they buy it, and then carry that loss back to the profitable year before, and then claim back some of the tax that they paid in the year prior as well. So that's the ATO is quite open about the fact that those two are designed partially to work hand in hand. So there's an ability to use both of them together, which could be pretty powerful.
Yeah, no, great insight, Nick. It's definitely not just it's going to save you money one way or the other. Either going to reduce the tax bill, or you're going to get some money back, if you paid tax in the past. So, thank you. Hey, look, we've got, are there sort of new deductions we hadn't heard about for manufacturers, or is it really these two are the main ones that are getting pushed out, or we're getting them for longer? And I wonder with the, just the second part to that question with the carryback, I mean, is this something that really just should be ongoing, rather than a short-term announcement, for companies. I mean, why wouldn't this just be an ongoing tax measure?
Yeah, look, I agree, and certainly I think in the first webinar that question was put to the team about the temporary full expensing, whether or not that'll continue. Hopefully it does. Hopefully it does, and hopefully the loss carryback continues as well. I think the sort of accelerated depreciation rules started around the time of the GFC, if my memory serves me right, and it was always an intention that they'd be rolled back eventually. And in reality, they went the other way, and they were expanded from writing off assets that cost less than $20,000 to 30 to 150 to no limit. So the longer these rules stay around, the better.
Yeah, now I've got some questions that have come through about the modern manufacturing initiative, the MMI. Look, that got announced. I got to say, it was 1.2 billion. It seemed like a pretty good number for the sector. When you start hearing the full budget numbers, it starts dwarfing the 1.2 billion, that's for sure. But look, did we hear anything in the budget about the MMI? I wasn't expecting any further insights. I thought that would be sort of treated separately. But anything at all come out about that, Nick?
Look, I haven't heard a whole lot more about the MMI coming out of the budget, Michael, unless you have.
Yeah. Okay. Now, just looking at what the budget means for manufacturers, I guess I'd probably take it a higher level and say, what does it mean for the economy? I think sort of big spending, should be a reason to have a more positive outlook on consumer behaviour. There will just in general be more money circulating around the economy, which is a broad sort of, I guess, demand factor for manufacturers, Australian manufacturers. Your views on that, Nick?
Yeah, agree with that. Big spending. I think, as I said before, the government's really trying to encourage behaviours in certain areas. There's investment in digital skills and AI. There's investment in things like patent boxes and accelerated depreciation on intangibles as well as tangible asset. They've made some tweaks to things like tax residency and employee share schemes, and I think the purpose of that is just to make inbound investment a little bit easier. And so it's just trying to, the government's putting money on the table and saying, let's make inbound investment a little bit easier. Let's encourage people to invest in research and development, whether they're, inbound investors or already here. And let's try and keep all those innovations in Australia. So this is where the government's coming up with things in the budget that's just trying to lead the behaviour that they want to see from the manufacturing industry.
Yeah. Yeah, and I think you probably need, as a manufacturer, to look, more broadly at the budget rather than, they don't tend to hone in directly on manufacturers necessarily, but even things like stimulating, housing construction and those measures that are put in, they'll benefit certain manufacturers that are making into that industry. It's probably a bit broader. I mean, we had asked for, and we'd love to see in the budget, a serious look at things like payroll tax. It's, we're competing as Australian manufacturers on a global stage. We've got higher energy costs. We're competing for wages. Having indirect taxes, add pressure to that. Your land taxes, your payroll taxes. Just makes it harder, and it is something within our government's control. They would have to work with, state governments to replace that tax. State governments obviously rely on that, but and we've seen them go some way into, we'd like to see, more manufacturing get pushed regional, and we've seen, the payroll tax. I believe Nick, that was sort of halved for, regional employers and manufacturers, but you could even go further and remove it altogether, really.
Yeah, look, I mean, it's easy to get a bee in your bonnet about payroll tax. It's remarkable that we've got a tax that penalises businesses for employing people. So, you know, that 50% discount on regional employers, that's a start. As you've said, we'd love to see the government go a lot further on that. But, you know, I guess who's going to take the lead on that? Because the states won't voluntarily give up a revenue stream. So that there's, as you say, a fair bit of cooperation required with the federal government and between the states.
Oh, there really is. I mean, it's a big part of the state's revenue, so the federal government almost need to lead it, right, if that's what they want. Energy costs is probably another major one. I noticed there was announcements, you know, for gas and various other aspects, but I'm not seeing anything large enough or any narrative around an expectation in the near term of energy costs being, you know, serious downward pressure on energy costs that would help Australian manufacturers. I may have missed it. Nick, do you have any views on that?
No, look, I mean, I didn't see anything huge in there. I mean, energy costs clearly are a large expense for manufacturers when they're running their factories and the likes, and we'd all like to see it come down. You know, there's some investment in renewable energies and so on in the budget. I would generally think there's a lead time on that sort of stuff, but, you know, we'll just wait and see how that one plays out.
Yeah. Okay. Well, look, I think we've got through the questions. I might just reflect on our results of the poll. So thank you for those that have responded. I didn't know what to expect. I probably expected, Nick, maybe a sort of a positive outlook from a big budget. The audience, well, there's sort of, I'd say it's mostly split between positive and neutral. So no one's feeling particularly negative about it, which I guess is good. But maybe some cautious optimism is maybe how you describe those results. So look, anything else you wanted to outline, Nick? Otherwise, we'll sort of thank everyone for attending and look to wrap this up.
Just a couple of quick comments, just going back to, you know, what would you like to have seen in the budget? I just feel like I need to put my tax and private business hat on for a minute and make a couple of comments on that. You know, the reduction of costs obviously, but things like the loss carryback, which I think is a good set of rules, only applies to companies. So a lot of business, particularly in the SME space, a lot of businesses are trading through other structures. Trusts, obviously, very common, you know, and partnerships and sole traders and the like, where the businesses are a bit smaller. They don't get the benefit of these loss carryback offsets, which is a bit disappointing, because that carves a lot of businesses out of that particular set of rules. They still get the accelerated, what's it called, the temporary full expensing, which is great, but not so much the loss carryback. The other one is just that, you know, we're still sort of seeing, well, we've still got two corporate tax rates. Basically, you've got 25% if your turnover is less than 50 million and 30 if your turnover's over. You know, it'd be really good to see either that threshold of 50 million lifted a lot higher, maybe add another zero onto it or another couple of zeros, or perhaps or get rid of it altogether and have a unified tax rate that's a bit lower.
Yep. Great, Nick. You took the opportunity, and I'd expect nothing less from a tax practitioner to be lobbying on behalf of his clients to get, you know, lower rates and fairer rules. So well said, and thank you. Again, thank you, everyone. We'll wrap this session up now. Take care.
Thanks, Michael. Thanks, everyone.